The market's reaction to the surprise federal election result was initially positive, but the global backdrop remains ominous. A quick update on the outlook for our interest rates, housing markets and equity markets. The Coalition's election win upset almost all predictions, but the removal of uncertainty around proposed policy changes appears to have given a boost to activity in housing, the stock market and to the currency, with the Australian dollar up around 1% the day after the result became clear, although unable to break above 70 cents. The fact that this is the case, despite the iron ore price trading around $100 per tonne, shows how universally expected an RBA rate cut is factored in. So our well-established forecast of a lower Aussie dollar throughout this financial year is intact, although now that the US interest rates appear to have peaked, the downside might be more limited for the new financial year. The main reason the RBA are looking at reducing official interest rates remains the low inflation rate, which is near record lows for both the CPI and core inflation. And the RBA had hoped the jobs market would keep improving to turn this around. But now unemployment is back up at 5.2% and underemployment is also higher. A couple of rate cuts appear inevitable. Fiscal policy will also be needed, so the imminent tax cuts and infrastructure investment is part of the solution. But the impact on housing credit growth is going to be very interesting. The combination of lower interest rates, some help from the regulator reducing so-called serviceability buffers, and no change to negative gearing and capital gains tax rules may be just the recipe needed to stabilise housing prices. In contrast, the offshore outlook has deteriorated, and there's little doubt that trade tensions are the driver of this downturn in global growth. The standoff with China is resembling a technology Cold War, but the US tariffs are also being imposed on Europe and Japan on cars, and most recently also on Mexico and India, and so trade volumes are naturally contracting. The other place this stress is being seen is in stock markets. As the chart shows, our ASX 200 reached fresh post-GFC highs since the federal election, but the US markets still have an ominous double top. We need to break above those levels to suggest confidence that the trade disputes can be resolved. So in the weeks ahead, we'll keep an eye on equity markets and their take on trade wars, on local property markets and the comfort they are taking from lower interest rates, and beyond Reserve Bank monetary policy, the latest GDP growth numbers, which look like they'll only be around 0.5% for Q1, making year-on-year growth at or just below 2%. But of course, that's looking in the rear vision mirror. The growth rate for the new financial year hopefully can trend back up closer to 3%. And that's the market update from Bendigo Bank.